And so I really look at this acquisition that we've gone through, the acquisition of our business, as more of a partnership. It's a strategic partnership. There's going to be a lot of advantages to it that I think we can get into the specifics of.
Yeah.
But for me, it was the right time because of my age, and also because of the dynamics of our particular business and really the desire to grow. One of the things we're telling clients, and Eric says this, Eric, my business partner, says this to clients a lot, is we want to make sure Johnson Brunetti is here 60 years from now. And in order to do that, we need to start doing the right thing now. And we've been doing the right thing for the last 10 years to make sure that the firm's not completely dependent on me. And now it's time to make sure that the firm has a foothold in our region, maybe even nationally, and we needed a partner to be able to do that.
One of the things.
This is the Business of Advice podcast, where we help good advisors become great business owners.
Welcome to a special edition of the Business of Advice podcast. Today we are here with a great friend and a great advisor here at Advisors Excel, Joel Johnson. Joel's been a huge part of our AE family. He's led our Rainmaker Masterminds. He's mentored literally hundreds of advisors, and he's a member of our Advisors Excel Hall of Fame and the founding member of the 1B Club, writing over $1 billion in annuities with Advisors Excel. Joel, my friend, welcome to the Business of Advice podcast.
Thank you, Cody. I'm really excited to be here.
Yeah, so this is kind of a first. I've not had one of our advisors on the show yet. A lot of people outside of our industry just to have thought leaders in that. But I think one of the reasons I wanted to have you on is you just well, there's a lot of things we could talk about, but there's some big recent news. You, after having a very successful business you built up, made the decision to sell the business. I know I've taken a lot of calls from advisors. I know you have too, but maybe just start off there. I know it's exciting news for you and your firm and some things it's going to bring to the table. So just what went into that, and maybe just give us a little update on the business transition.
Sure, Cody, and I want to do that, but I also want to come back to this a little bit later because we want to talk about what other advisors should be thinking of, because I have gotten a lot of calls.
Yep,
maybe
me
we should
too.
talk about some of those calls. But for me, there are a few factors. One is I'm 60 years old, been in this business since 1989. When I first got my license, so I've been doing this a long time. We built up an amazing business, but I have no family coming into the business. I have a young son that's in the business, but he is very conscious
Wants to do it his own way.
Well, he doesn't want to come into daddy's firm.
Yep.
So, and that's pretty, he has real strong feelings about that because he saw how I came up and being kind of a scrappy firm and so on. So that went into it a little bit, but we also want a firm that's going to be there for a long, long time. And so in today's environment, when I look at the fact that I'm 60 years old, it was a succession plan. The value of our business, because we are quite large as far as volume of business, profitability, assets under management, and so on. It was pretty much impossible for my business partners to buy me out at favorable terms.
Yeah.
Not impossible, period, but impossible at favorable terms. And so that all came into the equation or the thought process. In addition to that, we want to be able to grow. We're to the point where we really believe we should be doubling our business profitability and revenues every 3 years. Wow. We've done that for quite a while, and then that pace slowed down a little bit over the last 5 years, and I think part of it was because we need a strategic partner. I need some people that are more talented than I am helping me run that business, and we could go out and hire for that, or we could just partner with somebody. And so I really look at this acquisition that we've gone through, the acquisition of our business, as more of a partnership. It's a strategic partnership. There's going to be a lot of advantages to it that I think we can get into the specifics of.
Yeah.
But for me, it was the right time because of my age, and also because of the dynamics of our particular business and really the desire to grow. One of the things we're telling clients, and Eric says this, Eric, my business partner, says this to clients a lot, is we want to make sure Johnson Brunetti is here 60 years from now. And in order to do that, we need to start doing the right thing now. And we've been doing the right thing for the last 10 years to make sure that the firm's not completely dependent on me. And now it's time to make sure that the firm has a foothold in our region, maybe even nationally, and we needed a partner to be able to do that.
One of the things you said, I probably should have had you start with this, but as the business becomes more complex, it does get a little more difficult to continue to grow and scale it at the rate that you have. I probably should have started here, but maybe just give everyone that listens a little, because you're one of the best entrepreneurs that I know have met. You've done an incredible job building it, but maybe give perspective on where the business is at today. Like, what does it look like? I think that idea of it would be tough for someone to buy you out, or at least the other guys in the business, and just where it's at and the complexity that you have with it.
Sure. So we have 45 to 47 employees. I'm not sure. We're always hiring people. We'll do about $30 million of revenues this year. Profitability is very, very high there. And we're in 3 different markets, 3 different major markets: Connecticut, which is kind of one market, Boston, and Atlanta. Continuing to grow. We need management help in those areas. We need advisors help in those areas, so a lot of complexity there. We do all our books and all our financials in-house. We're financed on a cash basis, so we have no debt. We've got a lot of people that do an amazing job for us from a marketing standpoint, very sophisticated marketing, not just TV and radio and workshops, but incredibly sophisticated digital marketing process that's AI driven. It's behavioral based on the way the prospect behaves. And so we've got a lot of complexity in the business. Spent a lot of time developing those different channels. We're measuring things all the time. We're very data analytics driven. And so there are a lot of moving parts going on. And, again, to take it to the next level, I'm a little older, and quite frankly, I never thought we'd build the business up to this size. And so as a good CEO, I think I always ought to be asking, am I the person? Do I have the talent to take this business to the next level? I know what I'm really good at, but I also know that there are other people that have dealt in much larger companies or maybe more fast-growing companies that may be better than I am and may free me up to not do things that would be difficult or maybe frustrating for me to do.
I think part of why we did this, when you're in our new studio, so I know you're going to be shooting some stuff here later, so that was fun to have you in. And just you and I think both had taken, so many advisors know you with inside the AE family, right? You've trained hundreds of them and through the Rainmaker groups. I think I was taking a lot of calls, you're taking a lot of calls. I'm like, we should jump on and just talk about this. So, but really not just about you selling the business, more so like we're not going to talk about the number, but like driven a great value that you're getting for the business, right? It's a big multiple. I think we're seeing that in the space right now. And I think that's why a lot of people are interested. There's a lot of people doing acquisitions in the financial services space. So maybe before we jump in, you and I were on the phone talking about, here were the things that the firm really liked about your firm, right? And here was why the value or the multiple was so high. And so we're going to talk through some of those. Thought it would be a great opportunity for other advisors, or heck, any entrepreneur really, to think about their business and how do you increase the multiple or the equity value of the business. And a lot of times I think advisors don't think enough about that. And they think more about the profitability on a year-to-year basis and not the overall equity value. So I want to get into that. But before we jump into those like 6 ways to drive up your equity value, just any advice or words of wisdom, because I know a lot of advisors are getting approached. I think a lot have at least said like, man, should I be selling? I think the one thing that you and I have talked a lot about is sometimes they don't realize the compounding power of their business, right? If you're getting a 7, 8, 10 time multiple and you can grow it by $500,000 to $1 million a year, that's real life-changing value you're creating. So just any advice that you would have for people as they contemplate or think about that?
Yeah, well, the first thing I would say is I've been getting a lot of calls, and I think most of the people I've talked to should not even be thinking about selling.
Yeah.
Number one, I think when the covers are pulled back and those businesses are looked at, and I know nobody wants to necessarily hear this, but the businesses aren't as good of businesses as maybe the entrepreneur or the owner thinks they are. Those businesses are being driven by the owner, because the owner is an incredibly skilled salesperson. The owner is let's move forward at all costs. This is why we come back from conferences with ideas that drive our staffs crazy. And that's what's fueling that business. And when other businesses look at a business to buy, that's not necessarily what they're looking at. In fact, that can be a negative.
Yep.
And so I'm sorry, I forgot your original question.
Well, that was just any advice, that you would have as they're looking. I know one is like, you and I both probably agree with that. Some of them, I think they're years away from being
right.
Not that you couldn't sell today, but you're giving up a lot of potential value because the business isn't where it should be. Is maybe a better way to say that.
Right. I mean, if you think about it, if you're going to get a 7 to 10x multiple of profits, which again, these numbers, I was talking to somebody this morning, I don't like the way the multiple number is thrown around because they're measuring something different every time. And I think what we're hearing out there in the marketplace when somebody gets a 10 multiple or a 15 multiple, it's like comparing apples to oranges when you compare that to another deal. So I think that's important, is there's a lack of understanding out there. Secondly, if I'm going to get a 10 multiple, let's just make the math easy, and I grow my business next year by $1 million or in the next few years by $1 million, if I would have sold, I've given up $10 million of value.
Yeah.
Right? So you have this compounding effect if you continue to grow the business. that happens over time, that even if multiples compress, it would be almost impossible by just waiting 2 or 3 or 4 years to come out worse than you would if you sold today, and you're going to lose control and so on. So I just think there's a lot of pieces here that people need to think through. The other thing is, and I heard another entrepreneur say this, is we as entrepreneurs and salespeople get enamored with a deal. We get enamored with a transaction. And this was somebody in Silicon Valley, I think it might have been Mark Andreessen or something, said once an entrepreneur starts moving towards a deal and he's about 50% there, the deal takes over and logic goes out the window. And so when we hear this, oh, so-and-so sold or so-and-so sold, people get in love with the fact that, oh, there's another mountain to conquer, and they don't really think it through. They just get enamored with the closing of this deal, and that's where mistakes can really happen.
Well, I think one thing, too, some don't realize, and I know you'll be sticking around for quite a while in the firm, right? You're also still charged with growing it, but now you don't own it and get the profitability. So a lot of times I think the advisors I've talked to don't realize, like, probably not getting as high of a multiple as you think, because you have to be there for 3 to 5 years
That's right.
to drive it. So it's really, they're taking all the profits. So
Correct.
I think a lot to consider, but I think that's why we want to jump through some of these things that really do add some value to it. So if you're good, let's kind of walk through those.
Sure,
I know we've
let's
talked
go.
about it. So you and I were talking, and I don't know how we got on it, but we basically said there's these six things that someone's going to look at, or 6 ways to drive up the value. So I'll just kind of throw them out, and then maybe you can talk through a little bit of what
Sure.
you've seen in this transaction. So I think the first one, and this is maybe a big one, is they want to see this consistent growth of both revenues and profits. So it can't be, revenue at the expense of profit. In fact, our friend Keith Cunningham says, like, you should never make your life more complex if it doesn't lead to more profitability. So maybe just talk about how important that was as different groups. A lot of people were bidding on trying to buy your firm,
Sure.
and I know you picked one, but how important that idea of just they saw consistent growth year over year over year.
I mean, this goes back to the fundamental ways that stocks and companies are valued. If you go back to Benjamin Graham, it's a current value of a future cash flow. It's the present value of future cash flow. And that present value is increased by consistent growth rates. So if you're growing by 25% a year, some people say, well, Cody, I'm growing by 100% a year. Well, you're not big enough to measure that. It's easy to grow at 100% a year when you're doing $500,000 of revenues. But if you're growing by 20 or 30% per year, that increases that present value. Well, how do companies that are looking at you to buy, how do they measure that? They need to see absolute consistency. We're going to talk about systems and so on in place in a minute, but they need to see consistency in revenue growth and profitability growth. If all you're doing is growing your profits and your revenues are staying steady, that's not very interesting to a buyer, because you can do that by just cutting costs. If what you're doing is growing your revenues and you're not growing your profits, you got to be careful of that,
Something's
because
wrong
we're not a software firm. We're
Yep.
we're not buying market share. We're not trying to get there first like software companies and so on. They're buying a business for its cash flow, and so you've got to have not equal, but you have to have a pretty close correlation between that graph that shows your revenues and your profits. And it's got to be consistent, and it has to be able to be tracked back to certain systems that are in place. It can't just be because, your advisors are closing more, their closing ratio's going up. That doesn't cut it. It's got to be tracked back to systems and processes.
That's a good, and we'll probably talk about this one last a little bit, but you also have to be able to tell a good narrative around that growth, right? I think is what you're saying. On the flip side, I would tell anyone, any business owner, like, if you have one of those years where it is off, that's going to be a red flag. So you also better have a very good narrative around why, either revenues or profits were down in a year. I don't know that we saw it a ton in our industry. I think that COVID year, we thought maybe we were going to see that step back, but then it ended up,
Right.
not many people did, and, kind of grew through that. So, but I'm sure there are a lot of businesses that would be an example of being able to explain why, that there was an off year there. So,
Well, and interestingly enough, they also don't like it when there's a huge spike year.
yep.
So let's say you're growing at 20% a year, 20% a year, all of a sudden you're growing 100% and then you're back to 20. That raises a ton of questions, because that's a fluke, right? That's not a process-driven, planned out growth rate. That's a fluke. And that'll also make acquirers nervous, because they'll say, well, that could happen on the other side of things.
Yep.
They don't like that. They're buying they're paying a present value for a future stream of payments. And if that future stream of payments is consistent and it's growing at a compounded rate, it's going to be worth more, which goes back to what we talked about, where most advisors are looking at this prematurely. They really shouldn't be selling if it's just to get a check.
Well, and you know this, you're dealing with people who are very sophisticated financial analysts, right? And they're modeling this whole thing out. So the reason they love that consistency is it works really well in their formula, right? It's very easy for them to plug in the expected growth rate, what they're paying, and know how to make this thing make sense. So, okay, so that was one. You need consistent growth of both revenues and profits. The second one we talked about, and this is a big one because I've seen a few advisors maybe, I don't want to say making mistakes here, but that may be a good way to say it, is you need a good mix of revenue. And so do you want to talk through that? We can just play off that a little bit there.
Sure. Well, a good mix of revenue meaning different product lines.
Yep.
All right. So insurance, we can say annuities, but we could also say life insurance versus reoccurring revenues or fees. Some advisors, by the way, make the mistake of saying trailing annuity commissions as reoccurring revenues. That's not necessarily how it's looked at, although that's a whole other conversation. But when we say reoccurring revenues, we mean money management fees, consistent billing on money management. And that's got to be there. A lot of people are looking at selling, and they might have a 60 or 70% annuity revenue mix. I don't mean dollars brought in, I mean revenues.
Yep, just upfront revenues.
And that's not attractive.
It's not.
That's not attractive at all.
Well, it's actually, we have an advisor, when you would know, I won't mention them, but they said they were kind of looking and basically were told, like, your upfront revenue or year one revenue is way too high. Nobody's going to be interested. Or here's maybe the better point in why we're having this conversation. It's not that nobody would be interested. You're giving up a lot of equity value by not fixing that, right? So now on the flip side, we have a friend we both know, and I was just having this conversation with him. He was under the impression that it all needs to be recurring revenue. So he's almost shifted even his planning process to try and put it all into investments, at the expense of that revenue and profitability growth. And I told him that. I'm like, that shift is costing you, I don't know, $750,000 to $1 million a year in profits. And if you're looking to sell now, like, that's a lot of value. So I think sometimes they don't realize that. Obviously, if you had this massive recurring revenue, that's great. A lot of the advisors I know we work with and know don't really have that yet. Was there a number you saw there? Was it 50-50, 60-40?
What I saw so we talked to, is interesting. We thought we were going to have interest from 4 or 5 firms. We took 17 first meetings.
I'll bet that was fun.
It was a blast.
But you're patient. You love meetings, so I'm sure it was great.
It was awesome. I love meetings. And right off the bat, about 5 firms that we would know, big name firms, one of them right here in Kansas City, was not interested because of the high first-year commissions. And we're not even at 50%. Our revenues are way more than 50% reoccurring revenues from management fees. So some companies don't like that. Some are willing to count it all as one, but it still makes someone nervous, and that is going to reduce your multiple. You've got to have that reoccurring revenue mix. Now, on the other side of that, I would say that the example that you just gave of this person that's switching to, all reoccurring revenues from an investment standpoint, who's he doing that for? That doesn't make any sense.
Yeah.
I think we need to run our business as if we're not going to sell, but be cognizant of what creates value if you are going to sell. But turning around and doing something for somebody else, for something that may happen someday, at the cost of your profitability this year, maybe using that upfront money to market more and to grow more, I don't think that makes any sense. I think, and that also gets back to what's best for the client. I think we need to do, if we really believe that everybody should have some money that's safe, that's kind of a tough argument to make.
Good mix.
I don't want to get into the moral or ethics here. Not that we shouldn't, but I think you have to look at who are you doing this
Stick
for.
back to the lesson. The lesson is a good mix of revenue matters. It's got to be 50+%, I would say, easily recurring of your revenues if you want to get the value. But you also can't sacrifice value by going all recurring over a period of time. So, okay, so that was number 2. Number 3, this is something that I think you have done well. You've taught our advisors to do well. You've taught everyone the most important number to pay attention to is new first appointments generated. So I guess a an outcome of that is you have a proven method of new client acquisition. And I know that's one of the things the firms looked at is like you can get new people in the door consistently.
Correct, and there has to be a process to do that. But one of the things that was very attractive about us, so we'll bring on 550, 600 clients, 600 households this year, new relationships. That's very attractive, but it's not attractive unless you can say exactly how you're doing it. You've got the numbers behind it. They don't want to know that I'm the only person doing that, and so on and so forth. So there's got to be new client acquisition and a systematic process to get that new client acquisition. I was shocked a few years back. You talked about my Rainmaker coaching group. We did a survey on even the top offices and how many actual new people they're seeing every week, and it was shockingly low when people got honest about it.
Yeah.
It was like 2 or 3 new people a week. That's not enough. We'll see 60 this week, 50 or 60. And so there's got to be a way to bring in new clients. That's what's very attractive, and that's also very much valued in the business because a lot of firms cannot figure out how to do that.
Well, and I've seen that driving even some of our friends who have sold. Like that's part of why they're like, you could teach other people how to bring new clients in the door. I think the big thing there that I would tell everyone too is like that it's a well-documented process, right? If it's like, well, we just get a lot of referrals, that's going to hurt the value. But if you can show them, here's the different marketing methods we have and how consistent and reliable it is to bring new people in the door. It goes back to that whole idea of they know now. I'm not saying this is what the firm you're talking to is, but we could now go open up an office in wherever, Philadelphia or Charlotte or pick a city and just duplicate the system because it works. So that's a big one. Okay, fourth one, and this is a really big one. I know this is a area you have helped a ton of our advisors in, and I'm just going to call it no owner personality risk. And now there may be a little personality risk, right? But what I'm saying, I think there's 2 big things that you and I were talking about. One, you don't meet with clients anymore. So it's not relying upon you being this great salesperson, great advisor who converts. And then 2, I think you all have taken some steps to make it to where at one point you were very much the face of the organization, the face of the marketing, but have kind of gone away from that over the last few years. And those 2 things really drove the value also.
Yeah, I mean, if you back up and go back to about, when I first met you back in 2009 and even a few years before that, my goal was to build a business that wasn't dependent on me. And what I thought that meant was building a business where I didn't have to do all the selling. Well, fast forward a few years, and it also can't be completely dependent on me for marketing. So somebody that's doing all their TV, all their workshops, their own radio show, and so on, that's not attractive. That's a single person risk for a company out there that's looking to acquire. What they want to see, good diversification and so on. So I don't see any clients. We have 4 of our advisors, I think, now doing TV. I think we have 7 advisors doing workshops. I've given up the radio show. Now that's done by Eric, and Eric has other advisors on as sort of a guest kind of a show. So we have a host and 2 other advisors. So there's a lot of diversification. Now there's a huge cost to that diversification because if I did all that, we could probably drive more revenues today. So that's the other thing is the business has to be managed well enough today for you to diversify that. And an entrepreneur has to realize if I don't do everything, it's not going to maybe look as good today. But I see a lot of businesses that are still out there in our AE family and other advisory firms I know that are out there that are still way too dependent on one particular person. And again, it can be one person that drives the firm. You think of Edelman Financial. Rick was on the radio for many, many years. And that is a risk. It can also be a strength. So there's a balance there. But again, I think what a lot of this comes down to is that most advisors that own their own businesses do not spend enough time looking out there, not only at other businesses, but at the way public companies are valued. I was talking to Matt Dickin this morning about and Ryan Thacker about the ignorance, and that's going to sound harsh, but the ignorance of business owners in our business of just understanding how the world values businesses and how we do business, because we're kind of an incestuous parochial industry. And so I think that's really important. But getting back to what you're saying, you've got to diversify out that risk because this whole superstar brand, we're not LeBron James or Michael Jordan. That's not the brand. The brand is there's got to be a business that we have where the revenues continue even if we're not there.
Well, and you can be that, right? I think it's just more valuable if you're not, right? When they know, like, hey, if something happened to Joel, the business is still going to be fine. It
Right.
makes it more valuable than if, like, man, we're really relying, even the Edelman, I know he did the radio show and kind of the book, which you've done some of in the past, but I think, in those markets they were in, it's not like he was out there doing, workshops or stuff like that. They had other people and it kind of been able to diversify some of that. One thing you said that I think is really important for advisors to hear, though, is you didn't start doing that until you had the right team in place. And I just don't want someone to say, like, oh, you know what, I need to get out of that and put someone else on radio or TV that doesn't have the right people in place. And we've all seen advisors make that mistake. I'm going to be a rainmaker, so I'm just going to stop doing appointments and hire some people. You've got to bring those people along at the right pace, I think was important too.
And you've got to have talent, and it's not just advisory talent, it's marketing talent. I mean, we have people that, they get paid a lot of money, and they get paid a lot of money because they're extremely talented. And I'm talking about people that, post acquisition here, I would not be surprised if some of the top brass for this
Move them
acquirer
into some
wants
roles.
to. I'm going to have to fight to keep my people because my people are that talented. And so you've got to have not only talented advisors, but your marketing people, your financial people, your financial department. They better be able to speak the language of a public company, because those are the types of questions that are being asked.
We could probably do a whole nother one on podcast on, just upgrading the quality of your team and what that's allowed you to do to scale. So, okay. So fourth one was no owner personality risk, or minimize that. I think fifth one we talked about was duplicatable systems that can scale. So we've already talked about that a little bit from a marketing standpoint, just duplicatable. I think this was a little bit more about, operations, some of the back office stuff. So just any thoughts you want to share there?
Well, sure. So let's just talk about financial management, revenues and accounts payable and commissions payable and forecasting and projections and so on. I mean, I have one CPA and I have another woman that works with her that worked for Deloitte for many years on an audit team, and that's our financial department. That's a lot of horsepower for a 45, 47 employee company. They've got to be there, being able to duplicate those financials and produce those financials right away without any questions. A lot of guys think they know their numbers, and they put out these numbers, and I can look at the numbers right away and see there's holes in them. Some of them being in the Rainmaker Group that are pretty big offices. So that's got to be there. The marketing department has to be able to produce consistent results. It can't be 20 new appointments this week and 2 next week. It's got to be consistent results. It's got to be like clockwork. The processing of your investment business, processing the new business, relationships with custodians like TD Ameritrade, those all have to be well documented and processed. So again, anybody, if the head of that department gets hit by a bus, somebody else can come in from the outside and know exactly what they're doing there. And that's why, by the way, Advisors Excel has been such a great partner in that, because you guys have invested so much money in the wealth management side of things, in the annuity new business, in the life new business side of things, that you have processes in place that we can either just completely rely on you to process all that business, or learn from your expertise, build some of that in-house, and have the capability to do both.
Yeah, I think that's a big one. I think the other thing we talked about is just that ability for someone that's going to invest and sees this potential to grow and scale it. It just becomes everything we've talked about, from marketing to operations, those relationships, duplicatable, and that you can pick up and open, not unlike you open Boston than Atlanta, right? It makes it a lot easier if you have those systems. I would say it becomes critical if you're going to go, if you're going to open in multiple markets, because the complexity of that, greatly amplifies once you have multiple markets, multiple advisors trying to manage all that.
Correct.
Have there been any other challenges, a little off topic, that you've had in just opening other markets?
Well, you get into that reliance on a person. So now I'm not there, right?
Yeah.
So let's take Atlanta, for instance. I'm not there. We're a little more reliant on the talent of that advisor, or those 2 advisors that are down there, and the support staff, because they're a little out of sight. And so there's a dependency and a vulnerability there as a company, and you have to be very, very cognizant of that. And you know what? If it's not working out, it's your fault as a business owner. It's not their fault.
Yep.
Now, it might be something they're not doing, but you've got to take accountability there. So again, there's got to be processes in place, and the better that process is in place, especially a systematic sales process that can be teachable and transferable, the more confident you can be that sooner or later it's going to work. And now the only problem I have is I might not have the right people there, but the systems and the processes are in place.
Good. So 5th was duplicatable systems that can scale. 6, you kind of hit on this, and we will maybe even call it a bonus one, but I think it's a big one, especially when you're going into something like this where you're looking to sell and maximize value. You're going to be talking to very sophisticated financial people. The one we talked about is you need to have sophisticated financials yourself, and then you need to understand what those financials mean and what you're looking at. So just maybe I'll ask you like how important that is, but more importantly, are there certain things that an advisor really has to know about their business when it comes to the financials?
Well, I think an advisor needs to study how public accounting works in a publicly traded company. You have to understand that. These companies are big for a reason. We like to mock big companies. Oh, they move too slow and so on. But they're big for a reason. They're big because they have systems in place, and one of them is detailed financials and a certain way to look at financials. So we'll take the other extreme. You're not profitable just because you have money in the checkbook at the end of the month.
Yep.
And we laugh at that, but the version of that can just get more sophisticated, and still a version of that where a public company looks at their financials very, very differently, and advisors really should learn how to do that. It's not that hard to learn. You just go read the right books or listen to the right podcasts and so on. So I think that's really, really important.
Or hire people to do it for you and teach you, right? I mean, that's the other, even like ABOS that we've partnered with, that's a big part of just seeing them being able to not only give the advisors better financials, but then do some coaching and helping them understand it. It's a big thing. They don't really teach you that, when you become a financial advisor.
I mean, almost all of us are on cash-based accounting. You're not.
Yeah.
Almost all of us are on cash-based accounting, and we maybe when we get big enough should be on accrual-based accounting. And if I say that, most of the advisors listening to this don't even know what that means.
Yep.
So we've got to work hard to get ourselves educated.
That's good. Okay, so recapping the 6: consistent growth of revenue and profits, good mix of revenue, proven method of new client acquisition, no owner personality risk, duplicatable systems that can scale, sophisticated financial reporting is what we talked about. Anything we missed there, anything you want to hit on this before I jump into some lightning round questions with you?
Well, yeah, I think just stepping back a moment and just pulling back the curtain on the reason we did a deal is, we still want to grow. We want to grow very fast. We want to acquire firms. We wanted a partner to allow us to do that. And we had to have certain systems and process in place to even entertain that thought. And so there's this romance about doing a transaction. I just really want to caution people that, you really have to be careful of falling in love with the idea that this is happening to other firms and be really cautious about it. People have to go into this eyes wide open. If you're even going to consider it, you've got to think about the why. And then you've got to think about, am I going to be a better firm after the fact, or am I just cashing in? And I would say if you're just cashing in, be real cautious of that, because, if you just hung in there for another year or 2 or 3 or 4 years, you might get a much higher valuation. We're looking to acquire other firms. We now have a capital partner that can help us do that. So now we're in the position to acquire other firms, to run around the country and do that, or just grow in-house, or maybe even buy advisors' books of business and not acquiring other firms. But that's a whole other animal in itself. That's a very complex animal. Now you're buying personalities. You better be really patient in realizing that when you buy another firm, you're not just buying financials, you're buying people. And that can be a real challenge. And so we want to be able to do that, but we've thought long and hard to make the decision that we want to do that. And now we have a capital partner. But I don't think most advisors that I talk to are really, I don't want to say they're ready for that because it makes it sound almost derogatory towards them. I just think they're selling themselves short. But we will be looking for partners. But at the same time, we didn't do the deal exclusively for that. We did it for a number of different
just
reasons.
An added bonus for sure.
Exactly.
Well, I think one other thing I would say there is that sometimes advisors, and we know a few who've sold, and after they sold, were not very happy. And I think a lot of times what they don't realize is you're now working for somebody else. In most of these, in fact, I'm not sure I know of someone who has sold and been able to walk away from the business. A lot of the value is based on you're going to be around there for 3 to 5 years running it. And when you've been the boss forever, making that transition where now you have to report to somebody else can be a challenge too. So,
well, I talked to you and Dave about 6 months ago as we started this process, and I said, you know what, if I'm going to be miserable, I might be really miserable. I mean, there's a 50-50 shot. So, don't think that you're going to go into this and you're going to sell and you just get to continue to have 7 company cars and go out on your boat, supposedly entertaining clients and all this other stuff. because you're working for somebody
Definitely
else.
changes, right?
It changes, yeah.
So you're probably early enough in it, you're not seeing those changes quite yet.
Not yet.
And as long as you grow, hey, the other thing I've always noticed, even from our small experience with private equity back in 2010, that we made it about 3 years before we decided we were buying them back out, is they were great because as long as everything's going well, they're kind of going to leave you alone. But if you have a year where something's not off, then they're going to be in there a little bit more. So
I mean, that bar is set high because remember,
Yeah.
the people buying your business have other people that are investors in their business. For our deal, that wasn't an executive decision. They had to go to their private equity partners and their lenders
Yep.
and justify the deal. So you're held to an incredibly high standard, and I don't know that a lot of advisors realize that.
yeah, well, I'm excited for you. I'm excited to see kind of what this, I don't want to say final phase. That sounds bad when
Sounds
I say
depressing.
it, but it kind of is. I mean, I think even you've said that. It gives you a good 3 to 5 year window to really try and do
Yeah.
something great here. So excited to see what that looks like because it's been amazing what you've done, already. So let me jump into these lightning round questions
Sure.
I'd like to end with. So I'll start with the first one. I've said basically since COVID, I think we've all learned a lot of lessons, but is there one lesson that you've learned over the past few years that you think will stick with you for the rest of your life or business career?
The biggest thing that comes to mind is stop watching the news.
Yeah.
There's just so much nonsense out there, and my kids have helped me a little bit with that. Saying, "Hey, Dad, you're getting all riled up again. Don't watch the news." So that's one. That's a little off the cuff. Other lessons would be don't underestimate the talent you have in-house. I had no idea the level of talent we had, particularly with people that are under 30, and the qualities that they bring until we went through this whole COVID thing. And, one of the first things we did, Cody, is I got on the phone to Eric. I said, we're not laying anybody off. I don't care if we have to go backwards. I don't care if you and I have to go without paychecks.
Yep.
And we were fortunate that we were conservatively run enough to do that. When we made that announcement, I think that let people breathe a little bit because a lot of their spouses were getting laid off. And then we just saw people rise to the occasion. And I was just so impressed, and I'm so excited about that. I think the other is we do have to have, for us, a little bit more of a flexible work environment. I don't like the whole work at home thing. I don't like the work remotely. I don't think that the company is the same company when you do that.
Yep.
But at the same time, we are competing with other companies that will wave that carrot in front of somebody, so we better deal with that. For us, we don't have a work from home, but we do have a one day of the week that people can work from home. And I just need to get over it that, I don't know, if I was in my 30s and I was supposedly working from home, I wouldn't be working very hard.
Yeah.
But you know what? Like my son says, if they get their work done, who cares?
Yeah.
And so I think that's a big part of it, is just the appreciation of our younger people and understanding that, as a 60-year-old person, I need to be a little more open-minded to the stuff that made me the business person I am, which was rubbing elbows, asking questions, watching people inside their offices make phone calls and deal with meetings and so on. And, that might not be possible as much as it was when you have younger people working for you.
Well, that's a great transition to the next question. You're one of the best I've seen of just constantly investing into your own personal growth. Is there anything you're doing this year that, and maybe it's the transaction as part of that, but just anything you're really excited about in this coming year that you're investing in your own personal growth?
Well, Cameron Harold, our friend Cameron Harold, has this 3-year vivid vision, and I just started redoing that. I'm
Nice.
excited about that. We just came to the end of our last 3 years here. And so that's a big thing. I think if it's done correctly and if it's not all fluffy, if it's just really serious stuff, I'm going to be doing that. I'm going to read Keith Cunningham's book for the 3rd time. I think that book, The Road Less Stupid.
Yeah.
I've read a ton. I've learned, I didn't graduate from college, but I know more probably, it's going to sound arrogant, but I probably know more about business than most people that went to business school. Mm-hmm. But that book, because I've read so much, that book I think is the absolute best business book I've ever read. I'm reading that again. And then Michael Gerber's old book, the
E-Myth?
The E-Myth. I think every advisor ought to read that. When we first started Rainmaker 7 or 8 years ago, that was the first meeting, is just talking about the
Yep.
E-Myth. So kind of revisiting some of the classics, if you will, and then surrounding myself with great people.
Cool. Well, my third question was going to be, is there one book that you've recommended most to other business owners or entrepreneurs? I'm guessing one of those two would be at the top of the list.
Read those two.
Yeah, they're
And
great.
then a good management book, I think, is a book called How Google Works, written by Ben Horowitz, and who runs a big private equity firm now with Mark Andreessen and Eric Schmidt. And I think that's a really good management book because it talks about, although we're in different industries, it talks about having to manage these engineers that are rebellious and entrepreneurial and think they're smarter than everybody else. And as I say that, we should be sort of thinking about some of the advisors that work for us because that's how they are. And how does Google keep those people? And so it's kind of like herding cats. I think that's a good management book.
Cool. Great recommendations. Okay, I'm going to ask the final question I usually ask, but then I'm going to give you a bonus one. What is the best piece of advice you've ever received?
Make your boss look good.
Good.
Whoever you work for, make them look really good. And if you are the boss and you have business partners, be the easiest person they have to deal with and be the most profitable person. You know, I race cars and I'm probably the top customer at the shop that services the race cars. In fact, I can almost guarantee I've never asked for a price cut ever. And I get amazing service. And I think, you know, be easy to do business with, be a profitable customer. It's one of the things we've tried to do with our relationship with you guys. And there's a lot of people that I'm sure are not easy to do business with, and we worked really hard to be really easy to do business with. So those two things, if you work for somebody else, make your boss look good. And if you're running a business, be the easiest customer that somebody else has.
Okay, final question. Since you're the first advisor I've actually had on the podcast.
Hopefully I won't be the last.
Any words of wisdom for other advisors, or just, it could be business owners in general, but obviously you work so closely with us and have coached a lot of advisors. Like, any just final words of wisdom you would leave with them?
Yeah, be unselfish and develop your people. And be generous and do stuff behind the scenes. You know, if somebody's husband has a medical problem or wife has a medical problem, pay the bill, you know, make it happen. Somebody has legal issues, write a check, be quiet about it. Don't let people you're doing, just invest in your people. I don't think, you know, we make so much money in this business. And I think the more we let go of money, the more it comes back to us. It's a biblical principle, right? The more you give, the more you get. But don't give it because you're going to get, right? Just do it. Just be an amazing person that invests in your people. If you have a business partner, you know, don't try to figure out what's fair all the time. Just come to work. I mean, it'll all work out great.
That's good. Well, Joel, my friend, excited for you. I appreciate you taking the time to do this. Appreciate everything you've done for us over the years, and excited for what this next chapter holds. I know it's going to be fun to watch over the next 5 years or so where you all go from here. You're already at a level that I think most people, you know, would dream of getting to. So to see where it goes from here is going to be pretty awesome to watch.
Well, Cody, I appreciate the partnership with you guys and Dave and the whole team here. We would not be the same firm that we are today without your partnership.
So does that mean you're going to give me a bonus check or something?
Probably not.
No? Okay. Awesome. Hey, if you enjoyed this episode, go leave a review out there or share it with other people, share it on social media, and make sure you follow along on Facebook, Twitter, LinkedIn so you know anytime that we drop new episodes. Thank you all.